Welcome to a new episode of FinTalk from BHM Capital. The subject today is about portfolio management. We will focus with our guest to help our investors to understand few theoretical and practical aspects of how to manage your portfolio. My guest today is Andrew Cunningham. Hi, Andrew.
Hi, man. How are you?
How are you doing?
Good. Thanks for having me here.
FinTalk is a way to help our investors to understand basics of everything that we have in BHM Capital. So sometimes we talk about trading in general. Sometimes we talk about products like market making and stuff like that. Portfolio management is applicable to many products in equity or even other than equity. Today we want to focus about equity, capital markets.
Okay.
And we want to tell our investors about small techniques and maybe tricks to help them manage their portfolios in a safe way and to achieve their goals in the right possible way.
Sure.
So let's start with a simple definition of or a simple question of what makes a good portfolio manager?
So I think for the retail investor, I think a lot of retail investors make one big mistake, and that's putting all their eggs in one basket. You know, they hear from a friend or whatever, or on the news that a stock's doing really well, and they might put 50% of their money into that one stock or 100% of their money into that one stock. And, you know, that stock has a bad day, could lose 5% or, God forbid, 10% in a day, and they've just lost 10% of their net worth. So I believe the retail investors really need to focus on proper diversification, you know, diversifying across not just asset classes, but geographical regions, as well as the 11 various sectors in the equity market.
Okay. Which are? Can you just name a few of them?
Like energy, financials, healthcare, consumer discretionary, and so on.
Okay. So diversification.
Yeah.
How to implement it? I mean, assume I have $1 million.
Yeah.
Is it a right mechanism to put 100,000 in each share? How to do it?
So, I mean, typically I would recommend, so if you had 1 million dirhams and you put 100,000 in each share, then each share is basically getting 10% of your portfolio. I think you need to go a bit further than that. And my kind of key number is 33. So at least have 33 shares in your portfolio. That way, if they're equally weighted, that way each one is only going to be worth about 3% of your portfolio. So that way you're diversifying further. So, you know, if you have 10 shares in your portfolio and one of them goes down 50%, you've lost 5%.
But don't you think it's going to be a burden to the investor to manage and follow up with 33 shares?
It is maybe more of a burden to decide which shares you're going to allocate into your portfolio, do the research, do your homework, etc. But once you do have that diversification, you'll be able to sleep better at night. Because so if you have only 10 shares equally weighted, if one share goes down 50% or the company goes bust like an NMC or something like that, you could lose 5 to 10% of your whole portfolio. But if each share is only worth 3% of your portfolio and one goes completely bust, you've only lost 3%. So,
if I divide my portfolio into 3 pieces, very short term, or let's call it short term, daily trading or whatever, medium term and long term.
yeah.
What do you think is, or what is your way of dividing your portfolio?
I mean, I typically have a sort of long-term portfolio, which I have a lot of ETFs in, and those ones I don't regularly rebalance. I might look at them every quarter or 6 months. And then I have a more, that's what I call my trading portfolio, where it's more short-term, and I take, you know, more intraday trades, things where I think there might be a big move this week or in the next 2 weeks. And I try to keep about 80% of my investment funds in my long-term portfolio so I don't mess around with it, and then keep 20% for my more risky fun trading portfolio.
Local versus regional versus international. What do you think?
Everyone has home country bias. You're used to seeing your local stocks, Aldar, Fab, ADCB, etc. So you feel a kind of affinity to these names, but it's not good to put all of your eggs in your own regional stocks, whether you're here in the UAE or if you live in America. It's good to diversify.
Okay.
Let's say you could put something like, 40% into your local stocks and then spread the other 60% around various geographical regions. So you might want to put, say, 40% into your stocks from your home country, maybe 40% into the US markets because it's obviously the biggest market in the world. And then the other 20%, you could maybe put 5% into Latin America, maybe 5% into Asia.
Tell me, how do you find opportunities? See, talking about diversification is theoretical, and I'm 100% agreeing with you. But we are targeting investors who have heard this many times.
Yeah.
How to help them find the opportunity? I'm not asking you to give me what is the name of the share that I have to buy tomorrow.
Yeah.
But how do you do it? How do you look for an opportunity?
Typically, I come across opportunities just by staying up to date on the markets, reading the news daily, and every once in a while, I find some gem of an idea.
What makes it attractive to you?
It might be like a technical breakout, like maybe we're approaching like a new 52-week high or low. Maybe there's a specific chart pattern forming for an intraday trade or like short to medium term trade. On the investment side, for my longer term trades, I like to sort of buy the dip, as they say. So I always keep a bit of cash on hand, and whenever we see a big drop in the markets, I like to jump in and buy the dip. So, for example,
buy the dip.
Yeah.
So you like buying when blood is everywhere.
Exactly. It's as Warren Buffett says, buy when there's blood on the streets and sell when everyone's. But an example. So I had in my long-term ETF portfolio, I had it roughly split 70% equity ETFs and 30% bonds. And then the pandemic crash happens, the bonds rallied, the stocks crashed. I sold all the bond ETFs and just went 100% into equities. And a lot of people were fearful, saying, no, get out of equities. But I jumped in. And
that was very brave.
Yeah, a couple months later, I made a killing. So
I remember it very well. 2021, January, somewhere there, until March. I remember the markets well.
Yeah.
Then starting March 2020.
Yeah.
March 2020. The rally started.
Yeah.
And people who were able to buy before that date made so much money.
Yeah.
You mentioned ETFs a couple of times.
Yeah.
Tell us about ETFs. What is an ETF? And how can people invest in ETFs? How is it useful to them?
Sure. So an ETF basically stands for Exchange Traded Fund, and it's basically trades like a stock. So you can buy it and sell it, has a bid and an ask like a stock. But when you buy a unit of the fund, you're investing in a basket of stocks. So for example, SPY or SPY, the SPDR S&P 500 ETF, is made up. It's made up of the 500 shares in the S&P 500 index. So it basically like for like tracks the S&P 500. So it gives you instant diversification. Just by buying one ETF, you get exposure to rather 500 stocks. And then you can buy multiple ETFs. So you could say buy a high dividend ETF, you could buy a bond ETF, a junk bond ETF, a investment grade ETF, government bond ETFs. There is an ETF for everything out there. There are thousands or tens of thousands of ETFs. And we even have ETFs here in the local markets as well.
Yeah. So how do you decide which ETF is attractive to you today?
So there's a good website, ETF. It used to be called ETF Database or Database. The URL is etfdb.com. They've changed the name now. I don't remember what the name is, but the URL is still the same.
Mm-hmm.
And on there, they've basically got free screeners. They've got paid ones as well. But you can go in and you can find out which ETF has how much assets under management it has, what's the average daily volume, what are the fees you pay. So with an ETF, you don't pay, but there's a fee built into the price, into the spread, called the expense ratio. So the S&P 500, the SPY ETF, has a very low expense ratio. It's something like 0.09% or something like that, 9 basis points. And that's quite a low one, whereas other niche ETFs, like if you go and look for, say, like a video game ETF, that might not have as high assets under management or average daily volume, it's going to have a higher expense ratio. So you might get an expense ratio like 60 basis points or 75 basis points. But again, this isn't something that you have to pay. It doesn't come out of your trading account. It's just built into the price.
In the past, let's say 5 years, what was your best investment that you have done?
So my best investment actually that I ever did, and this is a funny one, I actually bought a URL, like a domain name, like a www.something.com for €1,000, and I sold it about 2 years later for 6,500 euros. So that's my, it was like 6.5 times, you know, so that's my best investment that I ever made. My best trade that I ever made, so in October, was it 2020? October 2020, when lockdowns, pandemics, 2 weeks before Pfizer announced their vaccine trial results, I had done my homework and I knew the results were coming and they were likely to be positive. I was on Twitter, I was obsessed every day on just Google News, Bloomberg, reading every article I could find about the Pfizer trial. I went long call options on EasyJet, which is a UK airline that's traded on the London Stock Exchange, and also on Norwegian Cruise Line Holdings, because the travel industry had been hit even worse.
Yeah.
At this point, after the March crash, most stocks had recovered and they were back to where they were or higher. But the travel industry was still way down. And I made, from that trade, I turned like $10,000 into $59,000. Just like that. The news came out, boom. It was, so that's my best actual trade in terms of multiples of what I put into it. But that was risky. Like buying a call option is risky. I don't remember. I think the expiry was till February, so it was like 5 or 6 months away. If the stock hadn't recovered, I would have lost the $10,000. It's not something I could have held forever. So,
in every episode, we end with an advice to investors with our guests. So, what is your advice to investors in the current market conditions?
My advice to investors would be to always diversify. Don't get too greedy. We all want to get rich quick and think that this is the trade that's going to make it. I've been there. I've done that and blown up accounts in my younger days. Always keep cash on hand, because buying a dip, an opportunity, you know, as we saw with the pandemic, it can just happen like this, a black swan event, and the market's down 30% from 1 week to the next or 1 day to the next. And if you're fully invested and you don't have any cash to take opportunity and jump into that dip, you're going to regret it.
Thank you, Andrew.
Thanks, man.
I hope you enjoyed our episode today. And as I always say, we will always keep going and we'll always try our best to give you more episodes with our experts in BHM Capital. Thank you very much.